Your car is probably your biggest business deduction, and the one most people do wrong. There are two completely different ways to write it off. The gap between them can be thousands of dollars, and one early mistake can lock you out of the better method for as long as you own the car. Here's the full picture: mileage versus actual, the heavy vehicle rules, and how to pick right. Let's break it down. First, the ground rule that applies to both methods: only business use counts. Client meetings, job sites, deliveries, supply runs, business. Commuting from home to a regular workplace and personal errands, not business ever. Your deduction rides entirely on your business use percentage, and that comes from one place: a mileage log. No log, no deduction. The IRS can and does throw out undocumented car write-offs. Method 1, the standard mileage rate. For 2026, it's 72.5 cents per business mile. That one rate is designed to cover everything: gas, oil, repairs, insurance, registration, and the wear on your car. You just multiply your logged business miles by the rate. Parking and tolls for business get added on top. Method 2, actual expenses. You add up everything the car really cost this year: gas, oil changes, repairs, tires, insurance, registration, lease payments, or depreciation, and deduct the business use percentage of that total. Drive the car 80% for business, deduct 80% of the costs. More record keeping, because now you're keeping receipts for everything, not just a mile log. And here's where your car deduction actually lands: Schedule C, Line 9, car and truck expenses. Straight from the IRS, whichever method you use, this is the line it flows into, backed by your log. For most gig workers and small businesses, it's one of the biggest numbers on the whole page. So which method wins? Here's the honest pattern. Standard mileage usually wins when you drive a lot of miles in a reliable, paid-off, fuel-efficient car: high miles, low costs. Actual expenses usually wins with an expensive or newer car, heavy depreciation, gas-hungry vehicles, or big repair years: low miles, high costs. The only way to know is to run both numbers your first year. Now the trap, the one that locks people in. The choice isn't freely switchable. If you want the flexibility to alternate, you must use standard mileage in the first year the car is in business service. Do that, and you can switch between methods later. But start with actual expenses using accelerated depreciation in year 1, and you're locked into actual for that car permanently. Let's run a real comparison. A courier drives 15,000 business miles in a paid-off Corolla. Standard method: 15,000 times 72.5 cents, $10,875. Actual method: about 7,000 in total costs, 80% business, 5,600 deduction. Standard wins by more than $5,000. High miles, cheap car, the rate is a gift. Flip the profile. A consultant puts 8,000 business miles on a new $55,000 SUV that's 80% business use. Standard, about 5,800. Actual, gas, insurance, and the big one, depreciation on a new vehicle, pushes real costs to 18,000. 80% is about 14,500. Actual wins by roughly $8,500. Expensive new vehicle, actual is the play. Which brings us to the heavy vehicle rules you've seen all over social media. Regular passenger cars have yearly caps on how much depreciation you can take. But vehicles over 6,000 pounds gross weight, big SUVs and trucks, escape those caps. With Section 179 and bonus depreciation back at 100%, a heavy vehicle used mostly for business can generate a very large first-year deduction. But before you buy a truck for the write-off, hear the fine print the videos skip. The deduction only applies to your business use percentage, and that percentage has to hold up with a log every year. Use it more than half for personal driving and the benefits shrink or claw back. And spending $60,000 to save maybe 15 isn't a strategy if you didn't need the truck. Never buy a deduction. Whichever method you choose, the system is the same. Run a mileage tracking app all year, automatically. Note the odometer on January 1st. Keep receipts if there's any chance you'll use actual. And in the first year with any new vehicle, calculate both methods before you file. That single hour of math protects your options and often fines thousands. Quick recap. 2 methods, 72.5 cents per business mile or real costs times business percentage. High miles and a cheap car favor standard. Expensive newer vehicles favor actual. Use standard in year 1 to keep the right to switch. Heavy vehicles unlock big first-year depreciation for real business use only, and none of it survives an audit without a mileage log. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, your car can be a 5-figure deduction if you track it, pick the right method, and keep your first-year options open. Run both calculations, respect the log, and ignore anyone telling you to buy a vehicle for the tax break. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.